Well, good afternoon, everybody. I think we are going to be getting started now. We have a number of people ready to go on the webinar. So let me start. Again, good afternoon from Boston. I'm Peter Pavlina, the founder of Hamersley Partners, and I'm here today with my three colleagues, who you will be introduced to momentarily. Just a couple things. First, thank you very much for taking the time to listen to our webinar, Raising Assets in the U.S. We're looking forward to rolling through our presentation here to give you some insights into the institutional investment management business in the U.S. The goal for this webinar is to provide you with some tips for asset raising in the U.S. And the plan here is to run through about 30 plus slides and to do it in about 40 minutes. So we'll try to be mindful of time. At the end of the presentation, we will be emailing the slides to everybody, so you should have those in your inbox. One final thing I'd like to add before we get started here is if you have questions, please feel free to type those questions in the chat text box that you have there on your screen. Let me give you a little rundown on the agenda. This is the agenda that we're going to be using here today. And the agenda has several parts to it. First, we're going to give you a little background on Hamersley Partners and give you some insight into the investor channels that we talk to, the audience that we talk to, really. The next few sections cover how we describe supply-demand for investment managers, and we'll get into that a little bit. And then we'll close with what we call the Hamersley marketing system, and we will be giving you some insights into how we think we are different from some of our peers out there. This particular slide gives a little background information on who Hamersley Partners is. We are a Boston-based institutional investment manager marketing firm, founded in 2004. We have 4 partners, 50 years experience, and we've raised close to $5 billion since inception. And those assets come from our various managers, and they've been raised in strategies like global equity, international equity, emerging markets, small cap, those types of strategies. We are an SEC registered broker-dealer, have been since inception, and we are a member of FINRA. On the bottom of this particular slide, you can see a couple pictures of the Boston Marathon, which was held last week, as a lot of you probably know. And we put this here not because we ran the marathon. Those days are long behind me, at least. But in fact, asset raising is like a marathon. It's a lot of work. It's a lot of pain. Takes a lot of time. It's not a sprint, so it's a long process. And in closing on this particular slide, a couple of points I'd like to make. First is that there is no secret formula for raising assets. I think most of you probably know that. It's more about having a plan, having a strategy, a marketing strategy, and implementing that plan with hard work. And that's how you ultimately get to the point of raising assets. And we have plenty of stories that would be very consistent with that theme. The second point I want to make here in closing on this slide is the notion of supply-demand, and you'll hear us talk more about that as we move forward, but the importance of supply-demand. Supply-demand is hugely important in the asset management business, and when I say that to describe what I'm talking about, when we think about supply, as a manager in your particular strategy, you want to have few competitors. And on the other hand, you want to have growing demand for a strategy. So as we think about working with managers, we spend a lot of time asking, what is the supply like? What is the demand like? And is this a manager that we can actually realistically raise money for, or there's just simply too much competition? Moving forward, here on this slide, you see pictures of the partners at Hamersley. Again, I'm Peter Pavlina. I started the firm 12 years ago. Andrew Phillips has been on board for about 9 years. Michael Wren for about 4 years, and Kanwar Singh to the right there has been with us since earlier this year, since January, but I've known Ken Moore for about 3 years, but more in an academic capacity. The managers we are currently working with, the slide says Hamersley Partners current strategies, several managers we are working with now. The first one, Global and International Equities, that is a manager in Montreal called Jaroslawski Fraser. We're very proud to represent JF, as we call them for short. They run these types of strategies, a large firm based in Montreal, and we do their marketing in the U.S. for them. The next two strategies come to us from our client, Essex Investment Management, Boston-based firm. The first one there, Clean Tech, Global Clean Tech Thematic. That is what we would describe as an ESG strategy. And if you don't know what ESG is, that's environmental, social, and governance. That is quite the buzz these days, that acronym at least. The next strategy there is healthcare, long short. That is a hedge fund strategy. Again, that Essex manages. The fourth one there is a fund of funds. That's a fund of niche managers, pretty esoteric strategies. Be happy to tell you more about that particular manager or any of our managers. And the last one there is a credit strategy, a long-short aviation sector manager. Moving along, this particular slide, the universe of institutional investors, what you have here is a snapshot, a very high-level snapshot of our database and the channels within our database. So you have consulting firms, corporate plans, endowments, foundations, etc. As you can see, there's a lot of firms there and a lot of contacts. We realistically view about 1,000 of those contacts as probably our primary contacts, the ones we talk to the most, the ones we have, what we would say, the best relationships with. You might ask, what is the source of this? What is the source for this list? Where does the database come from? The source has really come from many years of being in the business, 50 years collectively for all of us. And it comes from doing thousands of meetings, conference calls, and so forth. And it also comes from external databases that we use. All of these investors that you have listed here have been invested with us across all of our managers over the years. So we leverage these relationships to raise assets for our managers. Moving forward, let me take you to the next slide. Here, what you have in front of you is a depiction of the global wealth management industry. And you can see there that there are a number of the largest category, the private wealth category, and then you also have the pension funds. Those two categories, the private wealth in the blue and then the pensions, make up most of the assets there. So we try to be smart about how we access these different channels. The picture you have here is a snapshot of the global institutional investor universe. And the reason we look at this and think this is important is what we do is we try to understand the trends that are happening globally in the investment management world. And when I say trends, I'm thinking of things like asset allocation, and that could be asset allocation here in the U.S. or outside the U.S., in Australia, UK, wherever, or in Asia generally. We look at things like the shift from defined benefit into defined contribution. That's a trend that I think probably everybody on the call knows about. It's been a trend that's been happening for quite some time, and that has certain ramifications for types of vehicles, types of strategies that potential investors can invest in. So it's something that we really think a lot about. The next slide is, and in fact, the next few slides are in various ways, a snapshot of the top investors in each one of these categories. So for example, here we have consultants. And there's 6 consultants listed there. If you know the consulting world, you probably recognize all of these names. All of these, I'm happy to say, have been very supportive of our strategies, of our managers in various capacities over the years. We have very good relationships with these, long-standing relationships. We're very proud of the relationships we have with these consultants, and we feel very grateful and fortunate to have excellent reputation with these consulting firms. And maybe one thing to add here, when we think about marketing and we think about launching a campaign to market a particular strategy, what we often think about is, okay, let's start a campaign. Where do we go? Who do we market to? And ideally, what we want to do is start with the lowest hanging fruit, the highest probability investor, and then after we're done doing that, then we'll start with the largest consultants, the largest plan sponsors, and so forth as we implement our marketing campaign. Here you see 2 other categories, public funds and corporate funds. The public funds that you see listed there, all of these, with the exception of one, have been investors of ours, and most of those corporate funds have been investors of ours over the years and at various times with our managers. And there's 2 things to think about here when we think about marketing to these 2 categories. The first is this idea of going directly to these funds to market the services, and then there's also the indirect path. And when I say the indirect path, what I'm really talking about there is going through the so-called emerging manager programs, what we often call the MOMs, the manager of managers. Those have, over the years, been really a good source for us for raising assets for our managers. And then moving to endowments and foundations, these are, again, the top 10 in these categories, the top 10 endowments and the top 10 foundations. We have known these investors for many, many years. They've been investors in our strategies, whether here at Hamersley Partners or in our previous lives. And one of the good things about having been in this industry for so long, so many years, is we've been able to develop excellent relationships with professionals in these various organizations. And what we find happening over the years is the professionals will move from, say, one endowment, working at a specific endowment and moving to a foundation, or we'll see consultants moving from a consulting firm to an endowment or a foundation. And having these long relationships has made our lives a lot easier, and it's been very helpful in opening the doors for us into these various investors. And then earlier I showed you the pie chart with the different categories there, the private wealth being the largest category, and a category that's very important to us, and I'm sure will continue to be very important to us going forward. We here have multifamily offices, and then we have wealth advisors and private banks. We don't have listed here the single-family offices or the registered investment advisors, just because that we'd be overwhelming you with too much data. But anyway, I think the point that I would like to just drive home here is this idea of navigation, the ease at which we navigate these investors. So, for example, multifamily offices and single-family offices are a lot easier to navigate than, say, a large wealth advisor, the ones you see listed there, or private banks, generally speaking, simply because there are fewer decision makers, or there's only one decision maker, say, in the case of a single-family office. In the case of a multifamily office, there could be more decision makers, but of course they would be separated out by asset class and so forth. So, but in the case of the wealth advisor that you see listed there, it can be a lot more complicated because there can even be channels within each of those categories. Anyway, that's a little bit about Hamersley Partners, our background, who we are. I'm going to now turn it over to Kanwar Singh, and he's going to talk a little bit about the trends in asset allocation. And again, thank you for joining us. Thank you, Peter. I appreciate that introduction. So regarding asset allocation, before I begin, I want to ask you if you have any questions, don't hesitate to share. You can ask those questions using the chat text box, and we'll be happy to answer them at the end of this presentation. So asset allocation, as you can imagine, has significantly changed over the past decades. And so we've all heard of the 60-40 model, where institutions will invest 60% in equities and 40% in fixed income. Well, the data that we've looked at and that really sparked this webinar was the changes in asset allocation that have happened over the past few decades. So the slide that you have in front of you shows the asset allocation changes for Princeton universities. On the subsequent slides, we'll show you more examples of other large endowments that have done something similar. So on this slide, on the far left, you see the asset allocation across domestic equity, developed market equities, emerging market equities, independent return, private equity, real assets, fixed income, and cash for Princeton University in 1996. As you can imagine, the university was allocating a lot of its assets in domestic equity and developed market equities, and together that was around 55% of its portfolio. Well, since then, Princeton has made the dramatic decision to diversify their allocation of assets. And you can see this consistent trend towards decline in investments in public equities. In the most recent target that they've put out for 2016, this year, they are just hoping to invest 26% of their portfolio across domestic equities, developed market equities, and emerging market equities. So that to us is very concerning, because if we are seeing very significant declines in allocation of equities, the question that we ask ourselves is, where is the money flowing? And where are institutional investors allocating their assets? And we see that the allocations to independent returns, private equity, and real assets, in the case of Princeton, have all dramatically increased. The yellow, blue, and the green allocations have exceeded close to 80% in recent years. So why don't we take a look at the trend for the largest endowments, which you see on this slide. Obviously, just sharing a sample size of one would not convey the message that we're trying to convey, that the asset allocation models are changing. So I teach financial accounting at Harvard University with Peter Pavlina. Just as a side note, Peter Pavlina and I recently published a financial accounting textbook for Harvard, but we're also interested in selling that to our students worldwide. So if you're interested, you can contact us, and we'll be happy to tell you more about financial accounting and our course itself. But let's go back to asset allocation. And you can see here that if you look at Harvard, Harvard is also changing and has changed its asset allocation. They made, in the most recent fiscal year for which they reported their results, 33% of their assets were allocated to alternatives. Moreover, 24% were included in real assets. The allocation to public equities, which we here are defining as U.S. equity, developed markets, and emerging market equities, have shrunk and are only 30% of its ongoing portfolio. We see a similar situation for MIT, University of Pennsylvania, Columbia, Notre Dame, Stanford, etc. Now, the question you have to ask yourself is this trend continuing? And what happens to smaller institutions if they're looking at the leaders in this space? Now, the leaders certainly, as we see on the slide, have made significant allocations to alternatives and real assets. In fact, 8 out of the 10 universities that we've shown on this slide are investing more in alternatives and real assets than they are in public equities. So if we take a look on the next slide, which comes from an association of college endowments and universities, we certainly see the larger players are allocating to alternative strategies today. While the smaller universities and endowments are still allocating significantly to domestic equities and fixed income, we strongly believe that those allocations will shift, and the smaller endowments and universities will go after more alternative investment strategies as they become more liquid. So that's something that hopefully, if you are an investment manager, you should closely think about, and hopefully that's why you've joined the webinar,
is to look at these allocations and try to make a sense of where the market is heading. And we have two explanations for why this is going on. A, these investors and plan sponsors are deciding to go passive with their domestic strategies, but more importantly, they're just sending more of their investment dollars to alternatives and real assets. Now I'll ask my colleague Andrew Phillips to walk us through asset flow data and how that has changed in the recent years. Thank you, Andy.
Thank you, Kanwar, for that introduction. We wanted, as Kanwar said, to take a look at asset class flow data and asset flow data, beginning at the highest level here on slide 15 in front of you, looking at the flows to active traditional managers. You can see that I promise you there is data for 2011 there. It's a very slight decrease, too slight to be seen on your screen, but you see a marked shift away or flows out of public equities to alternatives, passives, hedge funds, really highlighted by 2015. And correspondingly on the fixed income side, you see $320 billion of net inflows over the 5 years. That's really spiked, though, as you'll see there, by the flight to safety, as we call it, in 2012, the European crisis, the S&P downgrade, those types of things. You're starting to see that turn already the back half of 2014 and 2015, as you can see there on the far right. So we're seeing those assets shift out of public equities. The question is, where are they going? We said they're going to alternatives, hedge funds, to passive strategies, and we're going to dig a bit deeper into that now and explore that trend. Here you see the flows to long-only equity managers. These are annual asset flows over the last 5 years, again, as with all these slides. You see significant outflows from U.S. equity. That's close to $1 trillion, about 980 billion or 982 billion over the last 5 years. So significant outflows from U.S. equity is continuing and shows no signs of abating. On the other hand, you see demand for global equity, demand for international equity, somewhat mirrored, interestingly, as you'll note there, due no doubt to the cyclicality of emerging market demand, which obviously peaked there in 2012, has come back a little bit in 2015. But that's a story that I think everybody should be familiar with. Further to the right on this chart here, you see regional strategies, and then what we've lumped as other equity strategies. So you have country-specific or other niche types of strategies in there, and those are showing persistent outflows, which I think is interesting and perhaps a little bit unexpected, but maybe a sign that allocator demand is not there to wholeheartedly embrace, country-specific or extremely niche strategies on a broad base. You'll find pockets of interest, obviously, as with anything, but for broad appetite is not there, perhaps. Slide 17 here, we're digging onto the hedge fund side, looking at the flows to hedge funds. You see, telling some of the story from slide 16 and slide 15 also, the flows into equity hedge funds, particularly in 2014 there, the money moving from long only into the hedge fund strategies, the equity hedge fund strategies, and also then in 2015 into equity hedge and into multi-asset strategies. Interestingly, on this chart or on this page, the fixed income flows, I think, showing what we termed here a flight to opportunity, because we're on the hedge fund side, obviously. So you see it starting in 2012, as with the top line numbers, but continuing into 2013 and even into 2014. The numbers do start to turn the back half of 2014 and into 2015 as those assets are flowing perhaps out of fixed income back into multi-asset or back into equity hedge. And perhaps the least surprising bit of information that we'll give you in this webinar is there on the far right, the cyclical nature of commodities. That is holding true, so it's nice to see that some things never change. Slide 18, this is the result of a survey done by eVestment Alliance of consulting firms looking at anticipated demand for public strategies and what they term private strategies, so private equity, and infrastructure, things such as that. The takeaway here, there are 2 points to take away. One being the predominance of global macro, the anticipated demand for global macro continuing strong. The second I would like you to keep in mind and file away for a couple slides from now is that other bucket, or that other slice of the pie under public strategies at 22.5%. That's special situations, quant strategies, sector-focused strategies, ESG, they're all down there in the footnote. Currencies, trend following, things such as that. So we'll come back to that in a couple slides. Slide 19, wanted to take a minute here and thank Investment Alliance for providing us with the asset flow data and the manager universe data from their database. It's tremendously valuable information, very, very useful in raising assets. We've been subscribed for 10 years and have found it to be an exceptional tool for targeting our outreach and for analyzing both managers and potential managers. You see here the universe of potential managers that we're going to dig deeper into over the next couple slides. Public equities is obviously the majority of it. Fixed income, hedge funds, and multi-asset sort of make up the other half. And there's an alternatives slice, which I know is growing and is a focus of eVestment's business. So this is just a little breakdown of that. Slide 20 here, what we're talking about is what is termed in the database investment focus. And so looking at the investment focus of these traditional managers, on the public equity side, you see obviously what some people would call an oversupply of U.S. equity managers. But you also see strong supply in global, international, and emerging markets, which I think highlights the need for several things that we're going to touch on, that I'll touch on, and that my colleague Michael Wren will come back and touch on shortly, which is consistency of performance and the ability to differentiate oneself versus peers as being sort of key aspects in asset raising. On the fixed income side, one sort of anecdote we wanted to share with this chart was on the sort of global or other buckets there. We've spoken in the past with a number of potential investors looking at emerging markets debt or global fixed income, and the overwhelming consensus that we've heard has really been that those investors, those large institutional investors, are looking for one shop to do both sovereign and corporate. Just a tidbit for those out there that maybe do one or the other as to a potential headwind or an opportunity to partner with somebody that complements the other side of your business to more successfully raise assets together. On 21, digging deeper into the hedge funds, similar by investment focus here. No real surprise, you see the predominance of equity long short, of macro, global macro, multi-strat, and credit long short. But I think what's interesting here, and what harkens back to page 18 that I asked you to remember, is the long tail on the right, where you've got those other strategies, the event-driven, the commodities, the niche strategies. There's areas of growth potential there, whether it's for managers to be populating their information in investment, to have it become known to those institutional investors, or for folks looking to start new strategies, or for folks that are miscategorized as equity long short and maybe should be categorized as niche or as volatility or what have you, or event driven for that matter. So something to think about there, certainly areas of growth on the right. Slide 22 here, the point that we wanted to make, I think, is fairly clear. The bars kind of tell the story themselves, right? Most hedge strategies have under 100 million in assets. 94% of the assets in the asset class reported in investment are with the 41 funds that are larger than $5 billion. The takeaway from this is twofold. One, that it's difficult to grow, and two, I think that it's important to have realistic A, growth expectations, and B, capacity expectations, or what you're telling potential investors how big you want to get, just so that you look like you're grounded and you know the space and don't have unrealistic expectations that lead them to think that you're going to close up shop in 6 months when you don't get anywhere close to it. Slide 23 here, similar, we're digging into the alternatives managers, looking at the investment focus again. Vast majority of managers self-reporting themselves as absolute return. I think there's a massive opportunity here under alternatives managers on the far right of the tail of the chart here. Again, for managers to be either reporting themselves as more what they actually are and changing their self-reported focus from absolute return to something else, to managers to launch new strategies. Certainly if you're a venture capital strategy and you're listening to us today, I would say get your data and investment, because there's only 3 peers there. So it may not be the #1 database for it. It may not be the way that everybody finds it, but it's low-hanging fruit at this point. Same for secondaries, same for private equity even, and for portable alpha. So there's opportunities for growth there for managers to be adding their strategies or folks to be starting new strategies. On slide 24, and lastly, before I turn things back over to my colleague Kanwar Singh again, similar story as with hedge funds in the alternative space. Majority of the assets are with the largest funds. 22 funds this time over $5 billion control 82% of the assets. And I think what we wanted to take away from this and the segue into the next section is the importance of being able to differentiate yourself as a smaller manager, even as a mid-sized manager, against those peers at the top end, against those 22 alternatives managers with over $5 billion or the 40 hedge funds that have 94% of the assets. You need to be going into meetings with consultants, differentiating yourself versus those large peers, and not saying I'm another Citadel, but saying this is how I'm different from Citadel and better than Citadel, or provide you a different exposure, different risk return. And that is how you're going to garner assets, incremental assets, or potentially assets as some of those large funds get reallocated away from. And with that, I will turn things over to Kanwar, and he's going to talk about, as I said, about consultants and the importance of consultants and the role of and the importance of differentiating yourself. So.
Thank you, Andy, for the segue. Before I show data on consultants and walk you through the increasing importance of consultants, I want to give you a background of what consultants do. Consultants have taken on broader roles in the asset allocation industry. The plan advisors are increasingly relying on consultants for advisory services to understand where they should be allocating assets and which managers they should be selecting. As Peter mentioned at the very beginning of this webinar, consultants are an important distribution channel for us. Hamersley Partners has close relationships with several consultants, and that has been one of the factors for our success because we've been able to manage those relationships. As you can see on this slide, 86% of investors, institutional investors, used a consultant over the past prior years. That is pretty big. In other words, if consultants don't appreciate or do not quite understand your specific strategy, you may have a tough time convincing consultants to recommend your strategy to institutional investors. And that's where we can come in and help. And Mike will talk more about how we have some tips on how you can work with consultants, among other channels in the institutional investor marketplace. Now, I want to walk you through what Andy mentioned in more detail, that consultants are very selective in the marketplace. The marketplace has become very institutional, and so as a result, the mechanism and the selection rates and the methodology that are used by consultants is closely replicated out there. So on this slide, you can see 3 separate funnels. On the far left, you see the funnel for average number of U.S. equity managers that were followed during searches. The middle one is for international equity managers. One on the far right is for fixed income managers. So let me walk you through the funnel on the far left. On average, consultants followed around 2,400 managers during active searches. 380 of those managers actually were able to sit down with these consultants and walk them through. There and then you can see how high the disapproval rates are. And then 85 managers were able to have an on-site meeting with consultants, out of which only 80 were selected as finalists. If you do the math, 3% of the managers that were actually followed during searches were selected by consultants as finalists during their active searches. And the numbers are fairly similar, 4% for international equity and then 8% for fixed income managers. The takeaway for you should be that A, it's really important to be professional and rigorous with your presentation, but more importantly, it's important to recognize that differentiation is key. If you can't explain very simply how you're different from your competitors, you may have a tough time convincing consultants. And similarly, as I mentioned, the market is becoming more institutional. So even the other plan sponsors, for whom, by the way, a lot of consultants are working as presidents or chief investment officers, they may also have a tough time being convinced why they should be allocating their assets to you. Now I'm going to hand it over to my colleague, Michael Wren, who will talk in more detail on some tips that we have here at Hamersley on how you can differentiate yourself and be successful out there. Thank you. Mike?
Thank you, Kanwar. Appreciate that. Hello, everybody. Michael Wren here. I've been with Hamersley Partners now for about 4 years, primarily in a sales role. So this particular section on Hamersley marketing is near and dear to me. Our process, or excuse me, our approach for hunting for assets is what we like to think is a little bit differentiated. We're very process oriented. Peter Pavlina, our founder here, is a CPA by trade, so process really runs through his blood. You know, talk about the way we do it on the next slide a little bit, but really it's not about just calling our friends and asking them to wire assets and then going out and partying. It's quite a bit less glamorous than that. I mean, I spent the last couple of days running around Connecticut and New York. I had about 10 meetings, and you know, for those of you that have been through that, you know it can be quite exhausting and challenging. But at the end of the day, that is really what we love to do. This slide here is going to show you a very linear process, just like a lot of your investment management pitch books are going to have regarding the process for which we like to implement when we take on a client and start marketing to the institutional space. Our process, you know, starts with the pre-marketing, and that goes along with, you know, creating the message, working on the marketing materials, things of that nature, and it runs all the way through to soliciting feedback from investors and then incorporating that into our message and generating leads. And all of this really is the goal of all this, I should say, is to build as many qualified prospects as possible. Right? This process raises the probability of finding assets, and you know, we think it's effective, and you know, it continues to evolve here as the market evolves. This slide here, factors for successful asset raising, is really one that we think that is massively important. And you know, if you do take away anything from this presentation, this is something that should be high on that list. Going through some of these bullet points here, favorable strategy, supply and demand. These are the things we've been talking about a lot during this webinar. And if you have a strategy that meets this criteria in a favorable fashion, as far as, you know, simple economics go, supply and demand, then you obviously have a better chance of garnering assets within the institutional space. Assets under management, track record, consistent outperformance, these are things that are not going to be news to anybody. If you have larger assets and a longer track record, you got a better chance. Healthy ownership structure and aligned incentives are things that, you know, you might take for granted. The management teams of investment managers often don't have the right incentives in place in order to succeed over the long term. Proven and passionate investment team. This again is just something it'll shine through in your meetings with consultants and allocators. If you have a passion for what you're doing, then that will show through, and you'll improve your chances. Competitive advantage. Why are you good? Differentiated edge. Why are you different? Being able to articulate these things, as Kanwar was just alluding to, is of paramount importance as well. It's something where if you can clearly define what gives you the advantage and the edge, then you know, you're going to be able to make things easier for the consultant to explain to their client. And at the end of the day, if it's easier for them to explain to their clients, who's the end buyer of the product, then you're going to have an improved chance of success. The last couple of points here: investing in active marketing, timely response to information requests. These are things. That's something where, if you come out of a meeting like I was yesterday, and I had an allocator ask me for something that we couldn't produce on the spot, if I could come out of that meeting, get that information from my client, and send it over to the allocator before I get in the taxi to go to the next meeting, that's powerful. That shows the investor that you mean business. And those kinds of things can go a long way in order to improve your chances. Realistic expectations, I think Andy touched on this earlier. I mean, if you think you're going to go out and raise assets and close your fund within the first, year, 6 months of marketing it, then, you're just setting yourself up for disappointment. This next slide here is our mass marketing channel. So we have, over the years, used these different press sources in order to help us spread the word, really, about our investment manager clients when we deem it's appropriate. Whether it be a press release when we first start a relationship, or if there's something in the news regarding some of the things that our investors that our managers are investing in, then we might take advantage of that as well. We like to leverage this technology in order to help us target our investors for our managers. The following slide here are examples of strategies of interest. I mean, as we've touched on here, the asset allocation pie has been evolving, quite a bit over the last number of years. It's only going to continue to evolve, in our opinion, and the pie is not going to get any bigger, but the slices are just going to get smaller. We expect that number of strategies to continue to grow over time here. Some of these didn't exist 10 years ago. This is just a list, this is a list of examples that will show you how that pie is growing. It's not an all-inclusive list, of course, but these are some things that we're hearing from investors that they might be interested in here in the coming year, 2 years, things of that nature. This following slide, what differentiates Hamersley Partners is just more of what we've talked about here a little bit. I mean, Hamersley Marketing Systems, disciplined, process-oriented. We love what we do. We leverage industry technology. We use Salesforce to keep us organized. Salesforce is a very powerful tool that allows us to crunch a lot of data in a short period of time in order to help target the types of investors that we think are going to be a good fit for our managers. We have long-standing relationships across the channels. I think we've touched on that a lot, but I think that's important because we do go across all of the channels, and so we're not necessarily focused on one specific channel, because every strategy is not necessarily a great fit for every channel. We use close collaboration with our manager clients. That means we're talking on a regular basis. We're trying to get the best out of we're trying to talk to the portfolio managers and get their best ideas. So when we go out and we start talking to investors, we can hit them with the best ideas and tell them why we think that our manager has got a better idea than the next guy, and this is something that you should sit up and listen to. Our team structure, again, I touched on that a little bit earlier, but when you come out of a meeting and I'm able to send an email over here to home base and ask somebody to produce some information and send it over to the investor, that certainly helps us along the sales cycle. And then I think Peter touched on it earlier. Our reputation, we believe, is high quality, and it's something that we take very seriously. And with that, the managers we partner with are very important. And if we come to allocators with managers that are of lesser quality, they're going to stop taking our calls. And when they stop taking our calls, that's the end of it for me. So this last slide here is some typical contract terms. We like to look at things in terms of an asset raise target, capacity allocation, contract length, momentum clause, expense reimbursement. All these things are subject to negotiation, but each contract is going to be different for each different manager, as all managers have different ideas of the way they want a relationship to look. But at the end of the day, what we like to think about is having our managers walk away happy. If indeed our relationship has to end with that manager, we want it to be a happy ending. So all that being said, I think that I just want to say thank you for joining us here today. There's some information here to contact us if you do have any questions regarding the webinar or anything else. And we will be sending this deck out, I believe, to all of you that are in attendance, so you will have that for your records. And also, I think I'm going to pass it over here to Andy and Peter, and they're going to answer some of the questions that have come in over the course of the webinar. So thank you very much, and here's Andy and Peter.
Thank you, Mike, for setting that up for us. We've had a number of questions, and we're glad that we have a few minutes here at the end to answer them for you.
So, and again, we want to say thank you, everybody, for joining us. And we've had a number of questions. I don't think we can get through all the questions, but we'll do our best to drive through these. So, Andy, a couple of the questions I'll ask Andy to answer. The first question comes from Pierre, and the question is, what is the definition of independent return? And we should have defined that earlier, but anyway, Andy, what is the...
Yeah, I think independent returns, we're referring to hedge funds there.
Yeah,
so.
And that's a category that we found in that report related to all those various endowments. And then Amy and Frank asked a question of what did we mean by alternatives, and maybe he addressed that subsequently, but I'll let you.
Yeah, I may have addressed that, but you know, we had some different data sets that we incorporated into this report that had varying definitions of alternatives, to be honest. But you know, the one that we ended up going with and using throughout the webinar was alternatives being venture capital, private equity, you know, infrastructure, absolute return, things such as that, private market type strategies, you know, non-publicly traded. So
right. And then there was an Andrew who had a question, and I'll let Andrew answer the question. And the question was, do you see these trends continuing as we move forward into 2016? And I think I have my opinion. I'm sure it's consistent with Andy's opinion, but go ahead.
Yeah, I think we do see the trends continuing. You know, obviously there are cyclical sectors within the trends. The fixed income, the folks at eVestment were kind enough to point out the cyclicality of that and how it had started to turn over from inflows to outflows late in 2014, and then throughout 2015 you saw. Commodities obviously are cyclical. Emerging markets is proven to be very cyclical, and to that end, you know, the global and international allocations. But I think by and large we do. I think, you know, U.S. equities is essentially something that people feel is very efficient, and they can gain you know, exposure and adequate, you know, market returns by going passive with it, paying lower fees, and using their risk budget elsewhere for some of these, you know, for the hedge funds or for the private strategies, the alternatives. So,
and if I can piggyback on that, I would say that we continue to see U.S. equity as a source of cash, not just going passive, but even a source of cash. And to echo what Mike said earlier about obviously the pie size is not changing, but they're smaller pieces of the pie, and you're going to see a lot more of those, well, what today perhaps we call esoteric strategies. And in Mike's example of the strategies of interest, we've enumerated a number of them in there. And then Rich.
Yeah, Rich had a question for you, Peter, I guess. Consultants, he says, have boxes that must be checked, whether it's AUM, length of track record, et cetera, before many of them will take a meeting. This being the case, you know, if a manager can't check those boxes right now, why bother pursuing those consultants?
Well, good. Thank you, Rich, for that question. It's a very good question, and believe me, we've had these conversations with our managers over the years. Managers often get very frustrated with consultants because they don't make decisions, they're slow, they take meetings, but nothing happens and all that. But I will say that while it can be frustrating to work with consultants, when you're on the other end of it and they like you and they recommend you, it's a beautiful thing because the money keeps coming in without a lot of incremental effort. So I can think of a couple examples of managers we worked with. In one case, for example, the manager had $1 million in assets under management, and we still went around to all the consultants, recognizing that we were not going to get a penny for probably a couple years. The reason we did that is because you have to lay the groundwork way in advance with a lot of these consultants. They want to follow the manager. They want to understand the manager. They want to meet with the manager every 6 months or have a call every quarter. It's a long process. And yeah, it would be easiest if we could just pick up the phone, call Stanford University and say, hey, Stanford, wire my manager money. But the world, unfortunately, doesn't really work that way. It's a long process, and the consultants, again, can be great sources of assets without much incremental work once they like you. So you have to lay the groundwork.
Well, and in that case that you mentioned, after we laid that groundwork, the consultants were responsible for, $560 million worth of AUM inflows over a period of 6 years.
Sure.
So
Right.
5 years.
Right.
So they can pay off in the long run. The consultants are the definition of a marathon, not a sprint, is what I would say.
Yes.
Next question was from.
But my running days are over.
Yes, exactly. Why I run. So the next question is from Kevin, perhaps a different Kevin. Has Hamersley raised assets from Luxembourg-regulated funds?
For Luxembourg.
For Luxembourg
regulated funds.
Yes.
Right.
Or any, with CCABs or SIFs or those types of vehicles?
Well, the answer is no. We have not raised assets for those types of vehicles. We have, we have raised money from, New York-based institutions for Luxembourg-based funds. Okay, and then there's another question. It looks like, what is the AUM range for the managers with which you have had as clients? It's a good question. Well, the range on the small side is virtually zero.
Almost $1 million.
The one that's right, and the manager Andy's talking about, they actually came to us with a paper portfolio. And yeah, that was a nice paper portfolio. The problem is we said, hey guys, if you want to raise money, there were a bunch of guys, if you want to raise money, you got to put money in the strategy and actually run real money first. So they seeded it with $1 million, and then we managed them. On the other end of the spectrum, we have a manager, Jaroslavsky Fraser, we spoke of earlier. They have close to $30 billion. It's almost all Canada, Canadian assets, Canadian clients, Canadian high net worth clients and institutions in Canadian equity strategies. So
almost like a second part of that question, Peter, how much have you raised for managers with which you've had as clients? So how much have we raised for our clients? That would be, that would be in the neighborhood of $4.7 billion since we started.
And is there, the question, is there demand in the U.S. for UK land? It said demands, I'm not sure what that means. But is there demand in the U.S. for UK land? I'm not sure I got the whole question, but for sure there's a demand in the U.S. for real estate. There's no question about that. That's part of the whole alternatives. We would love to work with a high-quality real estate manager wherever the real estate might be. I hope, and I apologize if we didn't answer that question. Do we have to be registered with the SEC if you're from Canada? Well, ultimately, if you want to raise a lot of money in the U.S., yes, you have to be registered with the SEC eventually, but maybe not right away. Do allocators react differently to non-SEC? Yes. The question is, do you have to be SEC registered? Do allocators react differently to non-SEC registered managers? And I think the short answer is yes.
I mean, we're not lawyers, but given the regulatory environment.
Yeah, by and large, if you had a choice, you will. Here's your universe. Here's the universe of your investors. It's that big. If you're not SEC registered, it's going to shrink. If you are SEC registered, it's going to be bigger. That's kind of the way. It doesn't mean you can't raise assets, but it'll be easier if you are registered. Go ahead.
So, question looks like our thoughts on demand for senior loan strategies.
Thank you for. Is that Roger? Is that who asked? I can't read the handwriting.
That's why I left the name out. So, I think senior loan strategies. We could click back to that page of alternatives or hedge funds. I think there's certainly demand for that, and I think there's definitely not a supply. The supply is definitely in your favor there. So there is certainly demand, and I think the supply of people that actually know how to do it and do it well is limited. So if you have a good story, If you have a track record that you bring, obviously that's always beneficial.
Right. Can I just add on that? We're very keen to talk to credit managers, no matter what type of credit.
Right. Whether it's asset-backed or consumer or peer-to-peer, or
right.
Any number of different credit strategies, loan strategies are very appealing as people look for uncorrelated returns.
Sure. And then Kit asked a question: how do we get on your platform? And and what are the costs? Do you take on emerging managers? Yes, of course we take emerging managers. We love emerging managers. That's how we got our start here, Kit. And I think you know a little bit about that background. Hexavest from Montreal really put us on the map. They were an emerging manager, and now they're a very large manager, and we're very proud of that relationship. And we're willing to talk to any manager. And the cost, I mean, we do have the contract terms lays out the cost, but we're always willing to negotiate and work with managers, and happy to have conversations with anyone. And Alexander asked for the strategy demand for Brazilian equity strategies. I would say that country strategies are generally more difficult. Brazil, China, India, the big countries are probably more of an exception, as opposed to smaller countries. But still, the question is how many investors out there, endowments, foundations, are actually allocating to country managers. And there's not a lot. There are some. We talk to them. We know who they are, but they're pretty selective.
Yeah, I would say. I mean, we saw that on the slide where we broke down the equity managers by investment focus. That Brazilian equity would be lumped under other as a country specific, and there've been outflows there, no doubt. And I think, as I said at that point, obviously there have been outflows across the broad spectrum of it, but the BRICS, the larger, the hot countries are always going to have certain folks looking to invest. It's definitely a smaller number, and the ticket size definitely matters. And I think the issue there that we've run into with a lot of country-specific managers is it really helps to have a commingled vehicle where you can take smaller mandates, because a fertile place for those is in the single-family office, high-net-worth space, and they need to be able to write you a smaller ticket than like a $25 million ticket.
Right.
So.
And then there's a question regarding the home bias for investors. Do investors have a home bias when they choose managers, and how has that evolved? I would say not necessarily. I don't think U.S. investors really have a home bias. I know, however, that investors like to be able to meet with the managers, and we sort of joke about in Australia. We know that Australian superannuation funds, for example, they like to get on airplanes and go to nice cities to visit managers. We mean that with respect, but we've run across that a lot. But no, there isn't much of a home bias. U.S. investors will invest in managers. In fact, maybe U.S. investors have less, in aggregate, perhaps, the opposite of a home bias, and would rather find managers operating locally.
Certainly less than they used to.
Yeah, in the various countries. Right. And then Ian asked what kind of vehicle, fund, i.e. a pooled vehicle, should be used in the U.S. for most of end clients mentioned today.
Yeah, and I think I just briefly touched on that, Ian. Certainly we like to see more vehicle options than fewer. Separate accounts is basically always going to be an option. For the institutional investors, depending on the strategy, commingled funds are very helpful, particularly if it's something where the overall allocation that the investor is making is a smaller chunk. So if you have an Indian equity strategy, for example, and you could only take a $50 million ticket, the list of folks that are going to be able to write that $50 million ticket is significantly lower than if you had a pooled vehicle where you could take a $3 million ticket or a $1 million ticket. So it's going to be a lot easier to raise assets with a vehicle that gives you a lower minimum. And a mutual fund feeds into that as well, and also opens up the private banks, the private bank side of the high net worth world, which they like to see mutual funds as well as separate accounts often, so that they can do multi-generational allocations. And I think the last question here as we wrap it up, and we're mindful of all your time here on this Wednesday, is do you work with funds that have U.S. investors only?
Yeah, the answer is yes. Yes, we work with funds that have U.S. investors only. In fact, in I guess maybe a couple cases, we had managers with only U.S. investors. So the answer is yes. So anyway, thank you very much.
Yep.
I think
Thank
that's
you
it for now. We appreciate your time and attendance here, and wish you well. And if you have any follow-up questions, please do let us know. Feel free to email us. Canwar's contact information is there, and we will be emailing out the presentation. With that, have a
Thank you all.
great afternoon.
Have a great afternoon.